Hello guys, and glad to have you on board again today. Like we do on a regular basis halfway through the week, we're going to have a look at some charts. But the thing is that today it would make no sense. Everyone has figured out that we're going to get the very much anticipated Fed meeting and the interest rate decision. But the thing is that my personal opinion, all the focus will be on the FOMC's press conference. But still, I wanted to make kind of a first shot at it, explaining everything there is to know, all the TLDR on how and what you want to expect from this meeting. So lots of people are bragging about expected volatility and stuff like that. The reason is pure and simple is because we have a lot of different market participants who have different visions on the markets, and they can hardly agree on a single value for everyone. So we've got lots of people saying Fed has gone too fast. They're going to have to slow down the pace immediately. Some say we're going to have to plateau immediately. Makes no sense. Some others say it is an appropriate time now to smash the market and send the real message that we're going to bring interest rates above inflation, and we're going to have to do it aggressively because the market doesn't get the message. So we'll see all about that. These whole things are based upon each and every one of those groups of people kind of trying to explain how their narrative is more rational than the others and stuff like that. So this is the same old lobbying type of things. Everyone is selling their shit. So, of course, don't listen to people's narrative. They might sound very logical and better than the others and stuff like that, but they remain nothing but lobbyism. So it's just these guys think they get the better answer, and they just want to make people think the same. So we're going to just look at charts and see, in terms of rational decision-making processes, what all that implies, because that's what matters the most. How the fuck you trade with those informations, not just trying to figure out how much the Fed is going to move, but what it will implicate on each and every direction that end up being chosen. Okay, so the other thing that I wanted to point out first before we leave onto some charts is that this is not just all about the FOMC this week, and I'm quite deceived that lots of people are underestimating the fact that we're going to get the BOG by tomorrow as well as the BOE. BOE is expected to rise by 50, and I tend to think that this could be something happening else. Something different happening in here, maybe a 75 basis point. So bear that in mind. It's not all about the Fed. Tomorrow could be a move day as well, though the BOG is not expected to move rates, though that could be a surprise as well. We've seen that the ECB has started to move. Lots of other central banks did as well. So could be a move from the BOG. So I would say, for now, the Fed is kind of stealing the microphone. Everyone is expecting the Fed, but I think the Fed is not going to do a shocking thing. It's going to remain pretty neutral and balanced to market's standard expectations. What I mean by that is that if we have a look at the consensus is largely around a 75 basis point rate hike, which we said will have multiple consequences. The first of it being that this would be the first time since earlier this year that the monetary policy derivative stance, meaning that the rate of growth, okay, will be the first one to slow down, because we've gone from 50 basis points to 75 and so on, okay, and then we get another 75, which means the rate, okay, the angle of that line has been going aggressive, okay, we've been accelerating. If you took basically the 75 basis points and dividing it into the time span in between the two hikes, okay, you get kind of a basis points per day metric. And in that perspective, this has been rising since then. So the question is now, if we get a 75 basis points, it's going to be the first time, because we have an extended summer duration between those two monetary policy conferences. And in that perspective, if we get the same old mechanics, dividing the basis points per day, this would be the first time that this metric goes down. So that means the rate of growth would be slowing down. And the market pays a lot of attention to this. So this would be the first factor to mention in. If we do this, that certainly doesn't mean the Fed pivots. In the general public, having a 75 basis point before or after having another 75 basis points, it's going to act like, well, we have a standard 75 basis points per meeting kind of metric, but the professionals know that there is a slight difference with this. The metric itself on the basis points per day is slowing down. So that would be a kind of a sign that the normal public wouldn't nearly pay attention to a 75 basis point. Only the professionals would get the hidden message. This is also an argument that people say, well, that would send a message to buy the dip for Wall Streeters, and this will probably thrive and support more inflation. I totally disagree with that. It's utterly stupid. But still, let's assume the other likely probability, or at least likelier probability. All of the other probabilities like 125, 150 seems pretty unlikely. And going below 75 makes no sense. So if we get a 100 basis point, which is exactly what the 10-year yield is standing at right now, that means that this is a possibility, not likely, but still a possibility to account for. The 50 basis points will be too far away. That means the 10-year yields would have anticipated badly, which I don't think is the case. So 75 is what the 10-year yields tells us, okay? 100 is the maximum pain level that the 10-year yield will accept. Anything higher is just my personal opinion, just raw imagination. But if we get 100 basis points, what would that change? That would change that if we take the math that we've explained, like taking the basis points per day and dividing it, we'll get quite the exact same thing as we did before. So that would be maintaining the derivative stance. But what that says is that if we get a 100 basis point, the rest of the market will figure out that after having a couple of 75s, we're now getting 100, that we're accelerating. So that means professionals will know that we're not accelerating in terms of basis points per day, but the retails will figure it out. So that could be a tool that the Fed could be using to manipulate unexperienced investors and luring them to believe that the Fed is going to be even more aggressive, when the reality is that they're not. So that could be a tool that the Fed could decide to use. But that's the only end game to me. If the Fed goes 100 basis points, it's because they want to lure the retail markets. The retails are going to panic shit sell, where the pros will likely buy their sells. Though, of course, that will create volatility, but I don't think it's going to change anything to the narrative. So let's talk about the whole thing, what the pros are actually thinking of. What are the plans? So the thing is that you have to understand one thing. The markets, the pros, don't give a fuck about what's happening now. What they matter is generally what happens 3 to 6 months from now. And to be honest, here's what the pros are talking about now. They're talking about this, what they call the final target rate. The final target for interest rate, which is the level in which they expect target rates to be 6 months from now, and particularly at the 17th of March meeting. So for now, if you get it right, that means if I follow my model, a 75 basis point followed by 50, and the Fed doesn't pivot, but the Fed kind of creates a slope, a linear slope, which will be driven by the 10-year yield, meaning that as long as the 10-year yield is higher, the Fed will just follow it. And the 10-year yield and the 10-year yields will be the guideline. So 10-year yield will go up and down, up and down. Sometimes will cross below, but normally every time it will keep rising to let the Fed rise interest rates accordingly. So this is not the soft landing that people believed, but this is the numerical kind of soft landing. So this means interest rate keeps on rising, and the 10-year yield is the driver. That's basically, yeah, it's not the Fed who's driving. It will be the 10-year yields driving. Like we said, the Fed has a very limited set of action in this stagflation environment. Remember what we said about the Phillips curve. If the Fed goes too aggressively trying to tackling inflation when it is actually created by side effect factors, all it will do is just destroy the employment markets and the job market. So it is that if Fed wants to have reasonable action on inflation, it will double down on the unemployment sector. So this is really kind of an only destructive way to do things. So obviously the Fed has to rise interest rates in accordance to inflation, but it doesn't have to go more than that, okay? So you have to understand the Fed's goal now is just to meet up with inflation numbers, and that's it. So the 6 months inflation is not something that we know, but it's something that the interbanking sector is actually having financial products to cover for. This is not something that you and I can trade, but there are some kind of insurance contracts for 6 months inflation swaps and over inflation. And in that perspective, the price of those cover trades in that perspective are very interesting because they give us a sense on how much professionals think inflation will either rise or dampen in the course of the next 6 months. And the 6-month inflation swaps currently shows decreasing prices, which means they think the peak inflation is there, of course, and that 6 months from now inflation will be at or below the current levels. And that's one thing. The expected level that I've seen from other professionals seems to be somewhere around 4.5%. Okay, so that's what I think inflation will be 6 months from now, 4 and 4.5%. 4 in the best case scenario, 4.5 as kind of a neutral stance, okay, and 5.5 at the worst case scenario. So this is where targeted inflation 6 months from now is. This is where we expect the Fed to start meeting with those interest rates and those inflation figures. So there are different curves to get there. So like I said, there's this curve, which allows the Fed to kind of put a slope in here and to try meeting by March or May next year the expected median target rate for inflation, which would be 4.5%. And we will get a 10-year yield and a Fed funds rate trading closer to this, okay? Always remember that the 10-year yield will be above. It will be leading the pack, and the Fed follows. So I expect the 10-year yields to be trading around 4.5% in the 17th of March. And in that perspective, 10-year yields will be nearly equal to the target rate for inflations. Though if you understand that, you understand why I've been using that model, because I think the 10-year yield will always lead and the Fed funds rate will always follow suit. There is also an alternative vision of this, which would be the Fed has to be proactive. And in that perspective, the Fed will have to rise target rates even faster, forcing the 10-year yields to eventually oscillate across. And that's a more aggressive stance. Though in that more aggressive stance, the 175 basis points make no sense. But if we look at the move, if the Fed goes 100 basis points, they have no choice but to make a 75 afterwards. I mean, pulling another 100 would be absolutely, utterly dangerous. If they do this, okay, what it's going to send as a message is, of course, this is where we're going to get no reduction in the basis points per day, meaning that the rate of growth derivative is not changing. It will change in the public's perception. After getting 75, we get 100, so they go aggressive, and then, oh, they're slow down, okay? So that will send the same message. They start to slow down by November in that perspective. But we know as professionals that it doesn't, meaning that we're still under risks to get another 75 afterwards, where the retails will say, well, we got 100, now we get 75, so we're obviously going to get 50, which is not going to be a guarantee, okay? And we just keep on going with that straight line momentum, which is very dangerous because that gives uncertainty for professionals. All the professionals care about is the moment in which that derivative will start to slow down so that we can pick up our models and say, this is the likeliest outcome, okay? So if we get 100, it maximizes the uncertainty because we're very likely going to get a 75 basis points afterwards, meaning that the only moment in which the basis points per day metric will start to slow down will be by the 14th of December, meaning that if the Fed goes 100 basis points, the likelihood of having 75 afterwards is nearly 100%, and then we will have to likely wait till the 14th of December until we get the confirmation that the derivative growth of basis points per day is starting to slow down. I hope you do understand. It's a bit more complicated, but like I said, professionals pay attention to the details. Only the dumb retails just look at the raw information. So that's really what this is all about, okay? Understand that anyhow and anyway, I think the 10-year yields have to meet with those levels. The current expectable target is 4.5%. This is the consensus around the people that I've been asking to about this matter. Some people go as high as 5.5% as a basis level for inflation, and we're never going to succeed going lower. Like I said, I kind of disagree. This level is reachable, but it requires the unemployment sector to rise. That, like we said, Phillips curve, if we want to draw down inflation to 4.5% over the midterm, then that means unemployment has to rise to 8 to 10%. We're talking about the real numbers, okay? Like the U6 unemployment has to go around 10%, which is currently standing at 7 to 8. So this is one thing. We're going to have to deteriorate the job market to get a better inflation number. And the end game anyway is to get to meet the 10-year yields with those inflation figures and nothing more, okay? We're not in a Volcker era, nothing, no such a thing. We're not in an entrenched situation of stagflation. We're going to get higher levels of inflation consistently over time for the next 2 years. That is what stagflation, moderate stagflation, is all about. Higher stance of inflation. And the only way to get out of this is not by smashing a higher interest rate by the Fed, but the only thing is to resolve the supply issues and stuff like that. Okay, remember what we talked about. This is a complex situation we're in. Whoever is trying to make it easy is just an asshole. Okay, so I'm just trying to explain all the nitty-gritty of that thing. So this is complex, okay, and there are more complexity than the one I just show you today, but at least I hope you understand the true mechanics that professionals are looking at. We're looking at the derivatives of things so that we can confirm our different models. The major difference throughout this weekend, the huge importance is that if we get a 75 basis point, we're going to get a confirmation of our bias by the next meeting, which will be November. Remember that we're probably not going to break resistances on the stock market until we get the confirmation, meaning that my personal opinion is going to be hard for the stock market to break a resistance before the 2nd of November if we get a 75 basis points, okay? And in the meantime, the market will look at all the nitty-gritty details of what Jerome Powell has to say, what's the color of its tie or stupid shit like that. We're going to have a look at tiny details to try orientating whether or not we're going to get confirmation by the next one. But anyway, professionals will truly wait for the 2nd of November until we actually break a resistance in the stock market. If we do not, if we get a 100 basis point instead, then first thing we're going to have to need is to see how the 10-year yield reacts. Is the 10-year yield oscillating across this level, or is it rising faster, leaving us the option to get a 75 basis points? Because remember, if we get 100, the next one is very likely 75. That means the 10-year yield has to keep on going straight line, really straight line. So there's no time to waste. Really no time to waste. Almost 1 month and 10 days from now, we're going to have to be 75 basis points higher with the 10-year yield, and something might be breaking along the way. So like I said, this is the risky bet. This is a risky bet if the Fed does that. The second conclusion is that if we do this, like we said, 75 basis points is the likely outcome afterwards, and the Fed will take the risk of eventually anticipating and meaning rising target rates above what the 10-year yields are doing, and that's a very bad sign. That means the Fed wants to be proactive against bond investors, which is not a good sign. Like I said, bond investors are really the only ones that backbone the economy. So these are the smart money guys. We're talking about trillions of dollars of liquidity, and you definitely don't want to mess up with those guys. But I mean, I don't know. Powell wants to show credibility. But if it does, like I said, remember that we're very likely going to get a 75 basis points, which is not going to change anything to the pace, the derivative. Though in that perspective, that means we're not going to get confirmation by the 14th of December. So if we get 100 basis points, that means the stock market will literally probably be impossible to break a resistance until the 14th of December. And if you get it all right, then you understand that, because if we look at the chart, here is where it is very likely going to be built. Remember that we're in supportive area, so whoever is dumb enough to sell in here, good luck with that. Like I said, that doesn't mean the bottom will be there. It just means the bottom could be lower, but you'd rather like to take into account that as a risk management. Basically, put a fucking stop loss large enough to account for this. The thing is that if we get a 75 basis points, looking at the next resistance and the fact that we're very likely going to break it by the 2nd of November, or at least try to, the target prices will be being as close as possible to that resistance by the next meeting. In that perspective, there is all the necessary nitty-gritty for risk management for traders to buy here and go there. So if we get a 75 basis point, I think the next move all across the month is to go bullish and try to target trades around the next resistance to get the confirmation on the 2nd of November. And if we get the confirmation, we're going to be able to pass through and then get to the next resistance. If we get a 100 basis point, like I said, we would be unable until December, okay? Though in that perspective, I think the market will dump first, get to the volatility boundary, the one we've highlighted, the 4-hour boundary. It's very likely going to drive us to the double top area. Might be some lower shadow candles below just to stop hunt or whatever. And then, of course, we're going to have to take another couple of months until we retrace up to the previous resistance for December, okay? And we'll have lots of uncertainty in between. These are the two major options to me. So like I said, if you want to trade this ahead of the Fed, meaning that you don't know if you're going to get a 100 basis point or 75, but you know what the two outcomes are. You understand that buying in here with a stop loss there to target that is a 1-to-1 ratio. We're in ranges, meaning that I got them tell you that some professionals are buying in here. They're not going buying bulk and putting all their money in here for a 1-to-1 ratio. I know my shit, so I can tell you that some people are buying in here because they don't want to be lagging if the market goes with the 75 basis points. But until then, you also have to understand that they will very likely have to risk manage as they have to profit take below the resistance before they get confirmation on the 2nd of November, okay? So that's the thing that I wanted to let you know. As we get 1-to-1 ratios in a range, you can be sure that professionals will take their trades in here and saving some money to buy again a second trade only if we get a 100 basis points. Now look at the fucking consensus. The consensus is 75% agree to get a 75 basis point. So this is the reason why if you have 75% chance to get there and 25% chance to get there before you get there, what the fuck do you do? Well, of course, you're going to take a trade here and you're going to save some money just in case this 25% chance still occurs. And of course, there are still less but still reasonable chances, existing chances, that we get something else, like 150 basis points or whatever, and then we break all the way down, everything flushes, and we're going to die. Then in that perspective, guess what? You take a stop loss, and it's not the end of the world. Remember that professionals trade. Professionals just don't try to know exactly what the future is made out of. We just take our models, price in the risks, see how much risk we're willing to take depending on the technical structures and so on, and we just put the fucking money in the market, and then the market decides. That's the reality of trading, boys. I'm sorry, but all the fucking bullshit that I've seen recently all over the place, people trying to figure out or understand, or no, it's complex, okay? I'm just trying to give you the basis to understand what the market traders are actually caring about, okay? So this is the best I could do for you guys today. See you later.